Welcome to the Nedgroup Investments podcast. I am Lulama Robertson, and today I'm sitting with Rob Johnson, Head of Investments at Nedgroup Investments. Welcome, Rob.
Thank you. Thanks very much for having me.
It's good to have you. So today we're going to be talking about the boutique advantage. Will you explain to me what it means when Nedgroup Investments says the boutique advantage and why it's important?
Yeah, absolutely. I'd be happy to. So we do believe that boutiques have a higher probability of being successful for underlying investors. And it's not to say that there aren't good asset managers sitting within big houses that aren't good and don't produce good results. It just means that we think that there's a higher probability that boutique asset managers will create an environment that means that the portfolio managers can be successful for their underlying clients. And I think there's a few things or key factors that I'd like to highlight why we think that is one is independence. They can, generally they're independent from outside influence and forces that might make them take decisions that might not be in line with the best interests of their underlying clients. They need to be autonomous, and they can be autonomous in terms of they're in charge of their own destiny. They can accept or decline to take on assets if it's in the best interest of their existing clients, for example. And also they can decide to evolve their strategy or develop their strategy as and when need be without outside influence. They can be focused. Generally, we prefer boutiques that are focused on a strategy or a small range of strategies that are in line with the way they believe running money creates the potential to be most successful. And finally, that alignment of interest, the alignment of interest straight through from the asset management business they've created themselves through to the portfolio manager who have an incentive to make that asset management work. And then the underlying clients, because the underlying clients are who they're running money for. They're always got to be conscious that they're running other people's money, not their own. And I think that alignment of interest creates a great environment for everybody to succeed and be rewarded for choosing a boutique investment house.
So in essence, the boutique managers have a great opportunity to have more skin in the game, given their independence.
Yeah, absolutely. I mean, if you think about it, they're trying to grow a pool of assets, and that pool of assets will grow from either strong performance, them providing good returns, either market-beating returns or absolute returns, and it will also grow by attracting people into their strategy through proving that they can create outperformance or good or strong performance. So as that pool of assets grows, the boutique manager gets paid more, which means the portfolio manager will generally take a bigger proportion of his success in those strategies, and that will then lead him to be more focused on the micro decisions within his portfolio, because everything he does will be looking to grow that pool of assets through performance if they're not attracting in assets in general. So that whole skin in the game, or the benefit from being aligned with the underlying investor is as you say, is much more beneficial for investors in the portfolio.
So in addition to that, what would you say creates, I'd say, a Goldilocks environment for a portfolio manager within a boutique asset manager?
Yeah, I think they have to have a focus on running money. Now, generally, a lot of the boutiques that are they're set up by investment professionals, and they've got an idea of how they want their house to run money. What you don't want them to happen is for them to be drawn into the daily running of the business, the attracting assets, the operational side of things, the IT infrastructure, the HR issues that they might have. You want them to be able to concentrate as much as possible on running money. Now, investment-led businesses are great, but you do want some sort of function within the boutique or outsourced function that enables them to carry on running money and be focused on that. That's important. And the other side of thing is that the other part of the environment that works nicely or needs to work nicely for them to be able to do that is stability. And stability generally comes through a decent sized pool of assets, which means you can be confident that investment boutique or that portfolio team is going to be around in 3, 5, 10, 20 years' time. That's what me as an investor, I want to invest in a company that I know is going to be there. But that pool of assets can be derived from a single investor, like a big sovereign wealth fund or a big institutional investor or a big one client that can take a decision to move that money at any. So you want a very broad range of underlying clients, different client channels, institutional, retail, direct investor, and also that within those, then you've got a broad range of underlying clients as well, because then it's much more difficult to destabilize the business. And as long as the manager knows and is comfortable that his business is being looked after and is stable, he can focus on running money for the benefit of the underlying investors. So those two important things I think I'd like to highlight.
And on the stability aspect, when you look at the whole investment team, so how do you then assess whether an investment team is say, the right size? Because perhaps you have two portfolio managers or leading a boutique asset manager. At what point in time is the team too big to maintain the qualities of the boutique manager that you find attractive?
Yeah, that's a great question. We get it a lot, actually. Surely it's better to have a large team running a portfolio than a smaller team. Surely more brains throwing ideas into the pot is better than a small team. Not necessarily. I mean, so it works for some strategies and blended strategies. But generally what you find is that the key individuals will control everything anyway. So it doesn't matter who's throwing ideas into the pot. Within a boutique, you've got everyone who's in there is there for a reason. And they're generating ideas, they're working for the success of the business, they're all aligned with the success of the principal investment managers, and everyone's working together cohesively to create success. That doesn't necessarily have the same impact if you're working in a large team within a large house. That's a generalization, but that would be my observation over time. Every additional hire in a boutique has to be brought in for a very specific reason to add value to this and create success for that business.
So it's interesting. It sounds like it generates a higher sense of responsibility and accountability.
Yeah, absolutely does. I think if you're empowered to bring ideas into the portfolio, and you see that actually happening, your ideas generating returns for the portfolio, it's very, very impactful in terms of your desire to work at that firm and your desire to keep providing those ideas. The other thing is when you've got additional people, you need to make sure you bring in a diversity of cognitive diversity, people who think differently, right? People who aren't just a copy of the original investment managers. They need to be adding value, as I mentioned earlier, and they need to be thinking differently to the way the existing managers are thinking, but also the way that the whole market might be thinking. And that's something that we see as important when our boutiques add individuals into their teams.
So that brings us to the NFL podcast. Rob, it's been such a pleasure having you and chatting to you. I do have one last question. If you only had one choice to choose between a boutique manager or a long-term established behemoth of manager, what would be the reason you choose a boutique?
That's a good question. I'm gonna change my answer slightly in that I'm going to say what I think is essential for identifying a good portfolio manager, whether it's a boutique or a behemoth. And it tends to be more prevalent within boutiques. Is I think that the ability to think differently to the market is the ability to generate ideas or a process or a way of investing that means that you're thinking differently to everyone else out there, because that will enable you to jump on opportunities that other people aren't seeing and create a real return or a return over and above what everyone else is earning. So that ability to think differently really, I think, is a characteristic, and it's evident in a lot of the most high-profile managers around the world, is their ability to take a scenario, to project it into the future, and to think how things might turn out differently to what the market is generally thinking. And the current rate environment and the rate increases that we're seeing around the world is a great example of that.
Well, thank you. That's the boutique advantage. Thanks, Rob.
Absolute pleasure. Thank you for having me. I look forward to joining you again.
Definitely. Look forward to seeing you on the podcast again.
Thanks. Bye-bye.
Nedgroup Collective Investments is an authorised collective investments scheme manager in terms of the Collective Investments Schemes Control Act. Nedgroup Investments does not provide advice on financial products and will only give you factual information. For further details on our funds and to view our terms and conditions, please visit nedgroupinvestments.co.za. Nedgroup Investments. See money differently.